What's up, everybody? And today we're talking about something that's close to all of our hearts: passive income, because let's be real, who wouldn't want to earn money while they sleep? That's the dream, right? And the best part is, it's totally achievable. We're not talking about some get-rich-quick scheme here. We're talking about building sustainable income streams that work for you, even when you're not working. Over the next few minutes, we're going to be diving deep into the world of passive income, exploring proven strategies that you can start implementing today. We'll be covering everything from dividend investing to real estate and even staking cryptocurrency. So, buckle up, hit that subscribe button, and get ready to unlock the secrets to financial freedom. Let's get started. First up, let's talk about dividends. In the simplest terms, dividends are your share of a company's profits just for being a shareholder. Think of it like this: you're a part owner of the business, and as the business makes money, it shares some of those profits with you. Now, not all companies pay dividends. Some companies reinvest all their profits back into the business to fuel growth, while others distribute a portion of their earnings to shareholders. Typically, well-established, profitable companies are more likely to pay dividends. Investing in dividend-paying stocks can be a great way to generate passive income. Imagine waking up every quarter to a deposit in your brokerage account, just for owning a piece of a company. That's the beauty of dividends. But remember, investing always comes with risks. The stock market can be volatile, and dividend payments are never guaranteed. A company's financial performance can fluctuate, which can impact its ability to pay dividends. So, how do you choose the right dividend stocks? Well, it's not just about chasing the highest yield. You want to look for companies with a solid track record of dividend growth and a sustainable payout ratio. The payout ratio is simply the percentage of earnings paid out as dividends. A high payout ratio can be a red flag, as it might indicate that the company is stretching itself too thin. You want companies that can comfortably afford to pay their dividends and still have room to grow. Look for companies in industries with strong long-term prospects. Think about sectors like consumer staples, healthcare, or utilities. These industries tend to be more resilient during economic downturns. And of course, do your research. Don't just blindly follow the crowd or invest based on hype. Understand the business model, analyze their financials, and make sure you're comfortable with the company's long-term prospects. Dividend investing offers several key advantages. First and foremost, it's a source of passive income. You're literally earning money while you sleep, which can help supplement your regular income or even fund your early retirement. Second, dividends can provide a hedge against inflation. As inflation rises, the purchasing power of your money decreases. However, dividend-paying companies often increase their dividends over time, which can help offset the effects of inflation. Third, dividends can be a sign of financial health. Companies that consistently pay and increase their dividends tend to be more established and profitable, which can make them more attractive investments. Finally, dividend investing can be a great way to build wealth over the long term. By reinvesting your dividends, you're essentially buying more shares of the company, which can compound your returns over time. Now, while dividend investing can be incredibly rewarding, it's important to be aware of potential pitfalls. One common mistake is chasing high yields. Remember, a high dividend yield can sometimes be a sign of trouble, especially if the company's fundamentals are weak. Another mistake is ignoring the company's overall financial health. Just because a company pays a juicy dividend doesn't mean it's a good investment. Always look beyond the dividend yield and assess the company's profitability, debt levels, and future growth prospects. Diversification is key. Don't put all your eggs in one basket, or in this case, one dividend stock. Spread your investments across different sectors and industries to reduce your overall risk. And finally, be patient. Building a substantial passive income stream from dividends takes time. Don't expect to get rich quick. Focus on investing consistently over the long term and let the power of compounding work its magic. Now let's move on to another powerful avenue for passive income: real estate. For generations, real estate has been a cornerstone of wealth building, and for good reason. It offers a tangible asset with the potential for both cash flow and appreciation. Unlike stocks, which can be volatile and unpredictable, real estate provides a sense of security and stability. You can see it, touch it, and even live in it, making it a more tangible investment for many people. Investing in rental properties can generate consistent monthly income. Imagine collecting rent checks every month, covering your expenses, and even having some leftover cash flow. That's the power of real estate investing. Plus, real estate often appreciates in value over time. As demand for housing continues to grow, the value of your property can increase, providing you with significant long-term wealth potential. Now I know what you're thinking. Real estate investing sounds complicated and expensive. And while it's true that it requires capital and due diligence, it's more attainable than you might think. The first step is to educate yourself. There are countless resources available, from books and podcasts to online courses and real estate investing clubs. Learn the ins and outs of the market, understand the financials, and familiarize yourself with the legal aspects. Next, determine your investment strategy. Are you looking for turnkey properties that are ready to rent, or are you willing to put in some sweat equity to increase the value? Each strategy has its pros and cons, so it's important to find the right fit for your goals and risk tolerance. Once you have a clear strategy, start looking for properties in areas with strong rental demand and potential for appreciation. Consider factors like proximity to employment centers, schools, transportation, and amenities. Owning rental properties offers numerous benefits. As we discussed earlier, rental income can provide a steady stream of passive income, helping you achieve financial freedom and potentially retire early. But the benefits go beyond cash flow. Real estate also offers tax advantages. You can deduct expenses like mortgage interest, property taxes, insurance, and repairs, which can significantly reduce your tax liability. Moreover, real estate acts as a hedge against inflation. As the cost of living rises, so do rental rates, which can help protect your investment from the erosive effects of inflation. And let's not forget about the power of leverage. Unlike many other investments, you can buy real estate with borrowed money, allowing you to amplify your returns. By putting down a relatively small down payment, you can control a much larger asset. Of course, like any investment, real estate investing comes with its share of risks and potential pitfalls. One common mistake is overpaying for a property. It's crucial to conduct thorough due diligence, analyze comparable properties, and negotiate a fair price. Another mistake is underestimating expenses. Don't just focus on the rental income. Factor in costs like property taxes, insurance, maintenance, repairs, and potential vacancies. Poor tenant selection can also be a costly mistake. Thoroughly screen potential tenants to avoid those who might damage your property, pay rent late, or cause other problems. And finally, don't put all your eggs in one basket. Just like with stocks, diversification is key in real estate. Spread your investments across different property types, locations, and price points to mitigate risk. Alright, let's dive into the world of crypto and explore staking, a fascinating way to potentially earn passive income. Think of it like holding a term deposit at a bank, but instead of earning a tiny interest rate, you're locking up your cryptocurrency and getting rewarded in more cryptocurrency. It's like your crypto is working for you 24/7, generating more crypto babies. Now, you might be wondering, how does this whole staking thing even work? Well, it all boils down to blockchains that use something called a proof-of-stake consensus mechanism. This basically means that instead of miners solving complex puzzles to validate transactions like in Bitcoin, certain cryptocurrencies rely on holders who stake their coins to participate in the network's security and operations. These stakers essentially put up their coins as collateral, and in return for their commitment, they get rewarded with a portion of the newly minted coins or transaction fees. It's like being a shareholder in the network and earning dividends based on your stake. The more you stake, the higher your potential rewards could be. But remember, just like any other investment, staking comes with its own set of risks and rewards, and it's crucial to do your research and understand the ins and outs before jumping in head first. So, you're intrigued by staking and want to get started? That's great, but first things first, you need to choose the right cryptocurrency to stake. It's not as simple as picking the one with the highest advertised return. There are a few key factors to consider. First and foremost, you want to look for established projects with a strong track record, and a solid reputation in the crypto space. Think of it like investing in real estate. You wouldn't just buy any property without doing your due diligence. Look for cryptocurrencies with a proven track record of security, a dedicated development team, and a clear roadmap for the future. Next up, you'll want to consider the staking rewards and how they align with your investment goals. Some cryptocurrencies offer fixed rewards, while others have variable returns based on network activity. Do your research, compare different options, and choose a cryptocurrency that aligns with your risk tolerance and return expectations. And lastly, don't forget about the importance of diversification. Just like you wouldn't put all your eggs in one basket, it's generally a good idea to spread your risk by staking across multiple cryptocurrencies. This way, you can potentially minimize losses if one of your chosen cryptocurrencies experiences a downturn. Alright, now that you've got a good understanding of staking and how to choose the right cryptocurrency, let's explore the different ways you can actually stake your crypto. You see, there are a few different methods, each with its own pros and cons. One of the most popular and user-friendly methods is staking through a centralized exchange. Think of platforms like Coinbase, Binance, or Kraken. They offer staking services where you can simply deposit your crypto and they'll handle all the technical stuff for you. It's super convenient, especially for beginners. Another option is to stake your crypto using a dedicated software wallet. This gives you more control over your private keys and potentially higher rewards, but it also requires a bit more technical know-how. You'll need to choose a reputable wallet that supports the cryptocurrency you want to stake, and follow their instructions carefully. Now, if you're feeling a bit more adventurous and tech-savvy, you can also explore staking pools. These are groups of stakers who combine their resources to increase their chances of validating blocks and earning rewards. It's like joining forces with other investors to buy a larger property, more power, but also potentially more complexity. And lastly, there's something called cold staking, which is basically staking your crypto offline using a hardware wallet. This provides the highest level of security, but also means you won't have immediate access to your funds if you need them. It's like storing your gold in a vault. Super safe, but not exactly liquid. Now, before you dive headfirst into the world of staking, it's crucial to understand both the potential rewards and the risks involved. Just like any investment, staking has its ups and downs, and it's important to approach it with a balanced perspective. Let's start with the good stuff, the potential rewards. Staking can be a fantastic way to passively grow your cryptocurrency holdings over time. Imagine earning a steady stream of passive income just by holding onto your crypto. It's like having a money tree that keeps on giving. The returns can vary depending on the cryptocurrency and the staking method you choose, but it's not uncommon to see annual percentage yields ranging from 5% to 20% or even higher in some cases. But here's the catch. Staking also comes with its fair share of risks. One of the biggest risks is price volatility. Cryptocurrency prices are known for their wild swings, and if the price of your staked cryptocurrency drops significantly, your rewards might not be enough to offset the losses. It's like riding a roller coaster. You might experience some exhilarating highs, but you also need to be prepared for the stomach-churning drops. Another risk to be aware of is the possibility of slashing. This is when a portion of your staked crypto is penalized due to validator misbehavior or network downtime. It's like getting a parking ticket for your staked crypto. While slashing is relatively rare, it's still a possibility, especially if you're staking with a less reputable validator or pool. And lastly, don't forget about the importance of security. Staking often involves connecting your crypto wallet to external platforms, which can increase your risk of hacks or scams. It's like leaving your front door unlocked. You're making yourself an easy target for opportunistic criminals. Always double-check the security measures of any platform you use and be wary of phishing attempts or suspicious links. That wraps up our journey through the world of passive income. We've covered 3 incredible strategies: dividend investing, real estate, and staking crypto, each with its own unique advantages and challenges. Remember, building passive income takes time, effort, and a willingness to learn and adapt. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more tips on building passive income. And be sure to let me know in the comments which passive income stream you're most excited to try: dividends, real estate, or crypto staking. I'm eager to hear your thoughts.